Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, November 29, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. So all in all, in terms of the S&P, it was relatively flat day. The market was up a little bit, the market was down a little bit. At the end of the day, the S&P finished off 6 points, but really that's closer to the flat line than it's not. It's really not classified, at least in terms of the way I'm looking at it, as a down day, and that's really because of the amount of points that we made yesterday in that big up move. So a little bit of a consolidation day is kind of normal market behavior. Down 6 points isn't even consolidation. However, that being said, I do have various things to discuss tonight. I think we can weave in some lessons that'll be beneficial to everybody. Before we get started, let me first thank everybody for participating, posting comments underneath the video each and every night. I love the interaction. Please keep up the great work. In addition, please hit the like button on the video and also share the video with anybody that you think can benefit from this information. The main question is, does the market have more mustard in the jar to go higher, or are we going to stall out, turn around, go lower? What is going to happen from here? Well, we're going to unpack that. We're going to uncover exactly what the charts are telling me. I'm going to transfer that information over here, and we'll go from there. So first order of business is, let's just double check and make sure we understand what the takeaway from yesterday was. Now, I'm not saying yesterday's day was the beginning of a new rally that's going to last 10 years. That's not the point. The point is that when we have the type of up day yesterday and the type of close that we had, after the type of lows that we had and the struggle that we had to find a low, that's not necessarily a one-day event. Generally speaking, there's more upside coming. However, the market doesn't always make it as easy as pie, right? We know all about the trick, trap, fool, and frustrate. The market has to jerk you around. That's just the way it works. By the way, while we're looking at the daily chart, don't pay any attention to these two trend lines on the screen. I'm actually going to discuss those in a couple of moments when we go to an intraday 10-minute chart. But while we're talking about the daily chart, don't have any focus on those lines. They're meaningless for what we're discussing in terms of a daily perspective. Speaking of which, do we have higher to go from a daily perspective? And my answer is, I believe we do. I think they're going to at least challenge 277 to 277 and a half before we have any kind of a meaningful decline or pullback from the bottom that was recently made. Now, that doesn't mean we are or are not going to complete the C leg of this ABC pattern. For anybody new or for anybody that has forgot, here's the A leg, here's the B leg, and we're in the midst of the C leg, which will only complete above the high of the A leg. How high doesn't matter. As long as it gets above the A leg, that pattern is complete, finished, off the table. Doesn't mean the market can't go higher from there. It's just that particular pattern is over. Now, why do I say that's going to be resistance? A, why do I say the market's going to get up there? And B, why do I say that's resistance? And that brings up another point. Let me answer my questions first, and then I'll get to the point. A, yesterday, again, not a one-day event. Generally speaking, that's not the end of the move, especially in the middle of a range here off of a bottom. That's telling you that the market will likely go higher. So we haven't yet reached the 200-period moving average, nor obviously the 50-period moving average. We came close to the 200 today. I'll call it a teaser, and it's interesting because they came right in between the 200-period moving average and this pivot high over here that came in from the 13th of November. So that high was 275.33. The 200 is at 275.92, and then today's high, you can see it here, was at 275.55, so kind of in between, and that's like a teaser. They're going to get to the 200. They're not going to stop here and collapse back down. That's unlikely. However, we know where our bogey is. Our bogey is yesterday's low. As far away as that is, the market can still stay bullish as long as we don't close any day below yesterday's low. That's the bogey. So, we've established the fact that I believe higher prices are coming, but I've told you the reasons why. The overall reason is I believe we're still in the midst of an overall larger picture ABC pattern, so that doesn't have to happen overnight. However, we can go sideways or even pull back. However, I think the real resistance point that will hit, that will last for several days, will be more likely at the 277, 277.5 area. Why is that resistance? Well, there's at least 3 reasons that I can see on the chart why that's resistance. Anybody that's taken the course at Lazy E-mini Trader will know those same 3 reasons why that will be resistance to the market. What I like to call overhead resistance, overhead supply. Sellers will come in at that price area. The plan is I will be selling more of the long positions if we reach that area into strength. You always want to sell on your terms, not somebody else's terms. I want to sell when the market's strong. I want to sell on the way up, into strength. I don't want to be forced to sell on the way down because I missed an exit. That's very important information. You should probably jot that down on one of those sticky notes and put it on the computer. Now that I answered the questions of why I believe the market was going higher, where the bogey is on the downside, the fact that we know the market can certainly go sideways for a few days, eat some time off the clock before pushing higher, but I do believe that this will be the major or the next major area of resistance on the upside before we have a real pullback that's going to make everybody believe that it's over and the market's going all the way back down. But there's a point in which I want to make. So something funny happened yesterday. A friend of mine sends me an email, which was a forwarded email from something else. Now, he subscribes, believe it or not, a friend of mine subscribes to a stock picking service. Now you know why all this stuff is called lazy, because he's taken the course. I've taught him everything I know over years and years and years, as much as I can. He's thirsty for the information, but he's too lazy to go find the trades, so he believes somebody else. It's very strange, crazy. I don't even know what to call it, but here's the point. So he forwards me an email from a service. It doesn't matter which one it is, makes no difference. But the terminology is what mattered. So they were indicating they wanted to buy a certain stock. That's fine. And by the way, I'm not saying there aren't great services out there. That's not the point. But this is what you have to watch out for. In the email, the terminology was, I have to look at my notes here because I wrote the words down. Feel, looks like, I think, all as descriptive terms why this trader felt the stock was going higher. There was no real supporting information. So if there's any takeaway from that whatsoever, and I'm aware, and you should, I'm aware that traders try many different services out there, always looking for something that works. There's nothing wrong with that. You just want to stay away from the ones that use those terms. Feel, looks like, I think. You want the ones that say, here's what the price is going to be based on this information, and if I'm wrong, I'm going to be wrong if it goes below here. That's where I know I'm wrong. That's what you want to hear. Anything short of that, they have no idea what they're talking about. Soapbox done. We go to an intraday 10-minute chart. Just want to point something out. Got an email earlier from one of the listeners, one of the viewers, one of the loyal followers, just asking a question about the pullback this morning, and was that a pullback that I was looking for, and was that the pullback where it was okay to get long. I think that was what was implied. That wasn't what was asked in the email. I think it was implied. It's not the point, and it's a totally legitimate question. Happy to answer it, but it brought up a point to me where I wanted to show you why these particular trend lines are on the chart and why I felt that these were logical areas of support that could be bought looking for another push higher. Now, this is really more of a day trade type of scenario. From a swing trade perspective, you all know we're buying the market much lower. We were buying the market down in this area down here and to the left. That wasn't the point. The point is from an intraday perspective. Very simple. I just want to point this out. So we can look here and say the market consolidated here and broke out, and we know that markets like to come back and test former breakout and former breakdown areas, and that's exactly what happened. We had a little weird activity here, so we had a spike higher after we hit this support area. Now, this area isn't to the penny. 273.02 is where I have the line. Sometimes they spike through the even number. Sometimes they come up short of it. That wasn't the point. The point was the general area, the general zone. Why was that zone, at least on the first effort in the morning, why would it have been or likely to have been supportive of the market? And the reason is because that was where the market last broke out from. It came back to test a former breakout area. How many times have you heard me say that? The reason is because it happens over and over and over again, so that's why I discuss it over and over and over again. It's kind of like one of those things where you hear me pounding the table. And the lower horizontal trend line at 272 and a quarter, 272.30, in that general zone, same routine. We consolidated there. The market broke out from there. We never got there today, but when we did break lower, that was an area that would have been supportive of the market, and the market actually found support just a little bit higher. Now, anybody that's taken the course also knows that from the last pivot top to what came up short of the 272.30 area, that general zone, so really it didn't come up short because based on this 10-minute chart, it was very normal market behavior. The market did exactly what it was expected to do on time, put in the signal of a trend change, and what happened? Took off to the upside. I'm telling you, as sure as I'm sitting here, anybody that's taken the course will look at that, will stare at it for a moment and say, holy cow, yeah, it did. It happens over and over and over again. When you train your eye to know what to look for, it changes everything on the chart. Just to wrap up the S&P 500, again, I'm talking about the upside, but aware that there's nothing that says we can't have a down day or two, consolidate for a couple of days, and then push higher. Either one is possible. I'm not tied to either scenario, but what I am tied to is, until proven otherwise, that higher prices are coming. Now, I am aware that there's a meeting going on, the G20. It's really a nonsense Kabuki theater type of meeting. However, there is an important development that's likely to come out, either positive or negative, and that is that Trump is having a meeting with President Xi over in China. I think everybody's expecting us to hear some news that relates to tariffs, some kind of deal with China, something. We can expect some volatility around the rumors that come out of that meeting and then the actual information that comes out of that meeting. I don't care what the information is. We care what the market thinks about that information. By the way, before we move on to another chart and another discussion, just want to show you something I think is a little bit neat. I talked about the fact that the market stopped in between this pivot and this 200-period moving average. So if I bring over the hourly chart, it becomes more clear why that happened. So let's just say I draw a trend line. I put a line on the chart from where the market topped out today. So right here, if I go straight over, Look where it goes to. It goes right to a breakdown candle high. I can't get it in there straight, but you see the point. It goes right to a breakdown candle high on the hourly chart. So you see how it depends on which chart you're looking at and what your perspective is. Now, somebody not looking at the hourly chart, somebody trading off a 3-minute chart, sees the market rising, tries to jump on board, wonders why the market turns around. As soon as they jump on board and heads downward, they tried to catch the momentum. And had they looked at multiple different time frames, they would have never, ever got into that trade. Here's the IWM. Down a little bit today. I mean, we could call it lagging the market, I guess, but the reality is that after the type of day we had yesterday, there's not a lot we're going to make out of 20 cents here and 20 cents there in the SPY or the IWM. It's not really that big of a deal. We closed above the 20-period moving average. I think that's important. We didn't close above yesterday's high, but that's okay. They're going to try again. You see where they're likely headed. There is an important breakdown candle high in the IWM that they'll want to go test eventually. So they'll get there. It's just a matter of time. What track are they going to take to get there? You know, the market goes where it's going, but you never know exactly how it's going to get there. We're going to grandma's house, but we're not telling you how many stops we're going to make on the way, and we're not even going to tell you the direction, but we'll get there. Sometimes that's the way the market feels. Remember, trick, trap, fool, and frustrate, and then they get there. Still a little looming issue in the VIX. So the VIX was slightly up today. Now the market was slightly down across the board, but we're looming in the VIX. We're crunched in between the 20 and the 50 period moving average. I wouldn't say that this is a bearish pattern. Let me show you what I mean. Remember, when I see a chart, what I'm going to do is first focus on exactly what draws my attention right out of the gate. First thing I saw was a potential triangle. Not in love with these. They're not that meaningful most of the time, but I see it. So I want to look further. What do I see? And that's when I said the market's crunched in between those moving averages. Crunched means it's wedging together. And that is somewhat of a triangle. It's not a perfect one, but who cares? I'm just looking at it from a visual perspective. And generally speaking, you can see we're making higher lows and lower highs. Not every day, but that's the trend that's developing. That's the pattern that's developing on the chart. So it's going to come out of here in one direction or another. Which way? Well, we don't know yet. We need to look further. So let's get rid of those lines and let's look further. Now keep in mind, I'm not really analyzing the VIX for us. I'm analyzing a chart. You can do the same exercise no matter what chart it is, whether it's a 10-minute chart or a weekly chart or anything in between. It doesn't matter. So the next thing I see is this breakup candle low. So I know that that's a bogey. So as long as the market stays, or the VIX in this case stays, closing daily above that particular price level, that's bullish. That means that higher prices are possible, probable, or likely, however you want to put it, in the VIX as long as we don't close below that price level. All right, that's two things. So one is kind of, I don't know, and one is, it's bullish until it's not, and I know where it's not. What else we got? Well, we got another one. So I've got this huge breakup candle low. Now, we've never come down to test or close. We came down to test it, but we never closed below that. So that's still really in effect, happens to coincide with moving averages. So I know that that's also going to be supportive of the market. So basically what we have here is a big up move, and I'm not going to call this a bull flag pattern because that's a little ridiculous, but we have an up move, and basically we've just been going sideways. So it's inconclusive, but I wanted to go through the exercise with you to show you that you can look at a chart and you can see bullish or bearish behavior, know where you're right, where you're wrong, and then you start to get a sense based on how close you are to risk and what the chart really looks like. And when you factor in time to the equation, and that's all discussed in detail in the course, that's how you begin to develop a trade. You know where you're wrong. You know you would be taking the trade for the right reasons. And the last component you need would be a target for the trade. And we don't have a target on the VIX because, again, I believe it's inconclusive. I'm not going to start talking about an upside target on the VIX, which would mean downside in the market, meaning stock market. And I don't have a conclusive pattern to say that's what's going to happen in the VIX. In reality, we can come down to test this breakup candle low in the VIX. The market can be rising at the same time. We can hold this breakup candle low, go back up in the VIX, and be turning around in the market. That is absolutely a possibility that can play out in the scenario that we just went over based on this chart and everything we discussed about the market before. And I didn't even plan to go over that. That's what unfolded in my mind as I discussed it with the data that's in front of us. The transports, my second favorite market leading indicator. The IWM is my first one. You know that. We're into moving averages. We had a huge up day yesterday. We closed above an important level, but not above another important level. So give it some time. Let it eat some time off the clock. It's the same routine as the SPY. The breakup candle low from yesterday is really the bogey on the downside. It's far away, but that is the bogey. So maybe we put in a flag pattern. Maybe we just go higher. Maybe some news comes out of the G20 that spikes the market higher. Maybe some news comes out of the G20 that lets the market correct some more, pulls back a little bit, builds some energy, and then moves higher. That's another possibility. We just don't really know exactly the way it's going to happen, but I believe higher prices are coming based on everything that we went over thus far. The Qs, same thing, nothing new. All the markets look pretty much the same. We had a big up day yesterday, and today we had kind of a back and forth, spin your wheels in the sand. And by the way, I know I'm going to get some emails and some comments based on the type of candle that was put in today. I'm aware of it. I understand it. I understand the timing aspect of it as well. It's on the table. It's a puzzle piece. It's more obvious in the Qs than it is in the spiders, but I am aware of it, obviously. Which is another reason why I wouldn't necessarily be surprised if we went sideways for a few days, a little bit lower and sideways for a few days. Back and fill, it's called. The XLF, no new news. I mean, we were down a little bit more than we were in the spiders, for example, almost 1%. But again, as long as we stay inside of yesterday's low, then it's all good, and we're still poised for the XLF to participate in everything we just discussed. SMH, it's just another copy and paste. No new information. By the way, here's a side note. I meant to mention it before, however, I forgot, but here it is. I get asked all the time about indicators. What indicators do you use on the charts? All that kind of stuff. And most of you either have asked me that question, know the answer, or just know the answer. But those that are new, and that's fine, I like the questions. I want you to ask questions. The only way we learn is to ask questions. You can ask legit trading questions underneath, or charting questions underneath, or both the videos, and I'll answer them. Sometimes I give sarcastic comments, but that's a form of self-entertainment. Never take that stuff personally. I'm happy to answer legitimate questions with legitimate answers all day and all night long. Back to the indicators. So I get asked what indicators I use. And what's interesting is there is one indicator. I have discussed it before, and I want to show you exactly what it is. So maybe I'll link it underneath this video or send out an email with it later, or both, something like that. I want you to see what the indicator is. I think it's important to realize, because now we're at a point in time when you need to realize what this indicator is and how it's used. The reason is because it just worked perfectly. Gold is basically flat. It's consolidating to move higher. Nothing's changed in gold. No new information. Not sure anybody cares. Crude oil, boy, it looks like it's consolidating in a bearish flag formation in order to go lower. So crude oil is going to have to get up off the mat pretty soon, or it's going to take another leg lower. Where's that leg lower? It's probably in the 47.5 to 48 neighborhood. And then beyond that, we'll discuss it if we get to the 47.5 to 48 neighborhood. With that, folks, it's everything I wanted to and intended to discuss tonight, so I'm going to give it a wrap here. Don't forget to check out the indicator. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.